Third one, Corona, derivative analysis and valuation. Derivative analysis and valuations. What is the meaning of derivatives? Derivative is a contract. It's actually a derivative is a financial instrument. It's an asset. Okay. It's based on the if asset is favorable, then it is called as asset. In case it is unfavorable, financial instrument is unfavorable, then it is a financial liability. Okay. The derivative contract is between two parties. There are two parties in the contract. They will enter into a contract to buy or sell the underlying asset. The underlying asset can be a equity. Equity means stock and index, that is shares and index, bonds, commodities, currencies, interest rate. Okay. The price of the derivative contract fluctuates based on the value of its underlying asset. Okay. I'll explain you through example. Derivative contract is a contract between or agreement between two parties. In our example, I will take example of Mr. A and Mr. B. Both are entering into a contract to buy and sell. A is entering for buy the underlying asset. B is entering for sell the underlying asset. Okay. I will take an example of MRF shares. Okay. The spot price, current price of the MRF share in the current spot market is 1,50,000. Okay. Mr. A has an expectation that the price of the share will increase in future. Okay. B has an expectation that the price of MRF share will decrease in future. Okay. I will show you the timeline. We are in April 2025. Okay. The contract entered date. Okay. The contract on entered date, both are having the expectation that one is price will increase, another one is having expectation that the price of the MRF share will decrease. Okay. Both are entering into the contract a future date, that is December 2025. The contract will mature at December 2025 on a cash settlement basis. On the date of entering into the contract, both the party agreed to the pre-fixed price. Okay, this is a spot price. 1,50,000 is a spot price. Is current price. Pre-fixed price or a predetermined price is a future price. That is contract price. The gain or loss will be dependent on actual price of the share. Okay, one party has expectation that price will increase, so it has to enter into a buy contract. Another party has the expectation that the price will decrease, so he has entered into a sale contract. Okay, and the actual price in the market, the actual price of the share on December 2025 will decide whether Mr. A has a gain or Mr. B has a gain. Okay, so it's a contract. This is the cost. Okay. The cost. In accounting term, we have learned in case of profit, how will you find the profit? Profit equal to sales minus cost. Sales minus cost. So, in our example, the contract agreed by the both party to settle at a predetermined price or a prefixed price is 2 lakh. Now, the actual price, that is current on the date of settlement, what is the selling price of the share? The selling price of the share turns out to be 2,30,000 on December 2025. Contract price is 2 lakh. Okay, the actual price of the share is 2,30,000. So he will pay 2 lakh to Mr. B. Okay, but these to Mr. B and buy that future share. Okay, agreed share and sell that share in the market. That is on the date of settlement. That is December 2025. Okay, so by this transaction, Mr. A will get a gain of 30,000. Okay. B will receive a prefixed price, that is 2 lakhs he will receive. Okay. He will receive a 2 lakh rupees. Now the actual price of in the market is 2,30,000. Okay, so the difference between prefixed price and actual price, that is this is future price, this is actual price. 30,000 is a loss for Mr. B. Okay, the market can be positive for Mr. A. Also, the expectation of the B is met in the second example. If the actual price is 1,70,000 on December 2025, what will happen? The actual price is 1,70,000, but the fixed price is 2 lakh rupees. Okay, 2 lakh rupees he will receive. He has to pay 2 lakh rupees to Mr. B and purchase the share of 1 lakh 70. So the loss will be 30,000. In case of Mr. B, he will receive a value of 2 lakh. He will buy the shares at 1 lakh 70,000. That is, the gain will be 30,000 for him. Okay. General, the derivative contract is based on the cash settlement. Assume every question or most of the questions having a cash settlement in our examination. Okay. The future market, one person's gain is equal to another person's loss. Okay. In general, if one person is getting gain, then another person the loss. Okay. Now we'll move to okay. Derivative is a financial instrument whose value is derived from the underlying asset. I have told you what do you mean by underlying asset. Underlying asset such as stock, index, bonds, commodities, currencies, interest rate. Okay. In syllabus, we have only stocks, index, bonds, and commodities in derivative chapter. Currencies and interest rate are covered in other chapters. That is, currencies, foreign currencies are covered under foreign currency transaction, that is forex. Also, we have interest rate risk management chapter. In that, we will cover interest rate as an underlying asset. So, the contract to buy underlying asset on a specified future date at a pre-fixed price. Derivative should have a buy and sale contract between two parties. There should be an underlying asset in the contract. Also, at a future date, at a specified future date, at a specified price, that is pre-fixed price. Okay. Now, for example, A and B are entering into a contract to buy and sell on the underlying asset MRF share on a specified future date. Both have the expectation that the price will increase and the price will decrease. So, in case the expectation is different, then only the future contract is possible. In case both have expectation that price will increase, so there is no concept of future in the transaction. Only when both the parties having a different opinion on the price fluctuation. Okay. Cash settlement, the net cash settlement will be done in the market by difference between the contract price and market price is settled in cash. There is the net payment in the cash settlement. In case of physical settlement, Mr. A and Mr. B will, Mr. A transfer the amount to Mr. B and share, the physical share, be transferred to Mr. A. Okay, that is known as physical settlement. Okay, types of derivative contract. Types of derivative contract. We have forwards, futures, options, swap. Okay, what do you mean by forwards? Forwards is a customized contract. Okay, customized contract to buy and sell an asset at a future date at an agreed price. The agreed price is fixed price, future date. Also, it is a customized contract. Customized contract means it's a face-to-face contract. Mr. A and Mr. B meet together. There is no online platform or a standardized contract. This is the customized contract between two parties. Okay, there is no regulation. There is no regulator like the SEBI. Okay, in case of futures, it is a standardized. There is a regulator in this contract. Okay, in case of forwards, only two parties enter into contract to buy and sell the underlying asset at a future specified future date, the agreed price. Okay, it is done at a over the counter basis, OTC, face to face. Okay, in case of future, it is a standardized and regularized. It has happened through the transactions are done through stock exchange. Stock exchange is a national stock exchange and Bombay Stock Exchange. BSE and NSE will be the mediator to buy and sell the future contract at a predetermined price. Okay. Options. A contract that gives the right to buy and sell the asset at a price specified in the future price. Okay. Predetermined price on a specific date. Okay. The forwards and future, the contract will happen at a future date at a prefixed price. Okay. In case of option, one party has a right to exercise the option or not to exercise the option. We will learn in detail in next video or a next part. Okay. Now we will be focusing on forwards and futures. Okay. Swaps. Swap contract where two parties exchange financial obligation. Example, interest rate swap and currency swap. So the swaps are not covered in chapter. It will be covered in forex and interest rate risk management. Okay. Participants in a derivative contract. First one is hedger. Hedger kills the risk. He exposed to risk. So he will enter into a future contract to kill the risk. So the participant uses the derivative to reduce or eliminate the risk of price fluctuation in the underlying asset. He has an underlying asset. I am already holding a Tata Steel share. Now I will be entering into a contract to kill the risk price fluctuation. I have an expectation that the price of the share will decrease. So I am holding a share. That is, I have buy contract. I have already bought the shares of Tata Steel. Now I have an expectation that the price will fall. So I will enter into a futures agreement so that the price will uh, fail. To eliminate the risk. I have a buy contract, so I will enter into opposite position in the market to reduce my risk. I will enter into a sell contract. So on the date of settlement, my loss will not be more than the I expected in spot market. Okay. Hedger generally hedger is a enter and use the derivative contract, that is futures option, to eliminate the risk and reduce the risk. Okay. I have taken an example of farmer uses the future contract to lock in price of crops to avoid losses in due to market volatility. In case the more supply is there, then the price of the crops will decrease. So the farmer will enter into a contract with the dealer to lock the price. Now the current price is 1,000. He expects that the price will reduce to 700. So he will enter into a contract with a dealer rupees of 900. So he will make a profit of 900. Okay. That is, hedger will do the derivative contract to reduce and eliminate the risk, to kill the risk by entering into the contract. Okay. The speculator actually buy and sell the shares by gaining the price based on the price movement. Okay. He will buy today the 1 rupee, 2 rupee gain. The speculators invest lakhs of amount by getting the returns. Okay. Traders take the position in the derivative market to earn a profit based on price movements. They will focus on price movements only. They assume high risk. Today they will invest in the various stocks. Tomorrow they will sell. Okay. By doing this, taking high risk, they will get a high return. Okay. An investor buys stock options, predicting the risk is in the stock price. Okay. Arbitrager take advantage of the price of differences between the market by simultaneously buying and selling an asset. Okay. They will enter into a buy contract and also enter into a sell contract to get the gain. Helps the reducing the price inefficiencies in the market. Both the contract they will enter and make profit. Okay. They will not get any losses in the arbitrator will not get any losses. Okay. Time the arbitrator will get a gain only. Forwards and futures. Now we will be moving to forwards and future. I have already told you forward contract is a private agreement between two parties. Okay. It is a private agreement between two parties to buy and sell an asset at a specified price on a future date. Okay. It is a customized traded over the counter OTC market rather than on an exchange. It is not traded on a exchanges, that is BSE and NSE. It will be traded on a over the counter basis. Future contract. Future contract is a standardized and a regularized contract to buy and sell an asset, that is underlying asset, shares, index, okay, commodities at a predetermined price on a future date. It is traded on an exchange, that is NSE BSE. Okay, and subject to daily settlement and margin requirement. We will prepare margin account. In that we will explain what you mean by margin requirement and daily settlement. Okay. Difference between forwards and future. Major differences over the counter and exchanges on a traded. It is face to face. Okay. Contract is for face to face. It is online NSE, BSE. Okay. Also, other differences is the customized contract, is the standardized contract, not regulated. It is regulated. That is SEBI is regulated by SEBI. Also settled at a contract expiry. The forward contracts are settled at a contract expiry. In case of futures, it will be daily mark-to-market settlement. We will prepare a mark-to-market margin in the next topic. Okay, counterparty. Counterparty risk is high as it depends on the counterparty's ability to pay. Okay, in case of exchanges, low as the exchange acts as a guarantor. Okay, BSE NSE acts as a guarantor, so there is no counterparty risk in the yes. Okay, liability. Liquidity is low. The contracts are customized. Liquidity is high. As contracts are standardized and actively traded. Okay, it is actively traded. So the liquidity is very high. margin requirement. There is no margin requirement in case of forwards, but in case of futures, margin is required to be maintained. If margin is reduced, then we have to pay the amount to bring the margin, initial margin requirements. Okay, used by the business for hedging, used by traders, speculators, investors. Okay, next is pricing of forwards and futures. The price of forwards and futures is determined based on cost of carry model, okay, which considers the current spot price and the cost of holding the asset until the contract's expiration. Okay, what do you mean by current spot price? It is the current spot market. It will be the price of spot market. If we'll take an example of Tata, the spot price of the today, what is the price is known as current spot price. So the cost of handling the asset. Okay, the future contract is for future date. Okay, I have a spot price. I will enter into a contract. Also, I have to have some cost of handling, that is interest dividend, okay, until the contract expiration. Now we will be computing what is fair future price. We will be learning what is the actual futures price. Actual price is really quoted price. Okay. How to value the future contract, that is fair price versus actual price. To determine if the future contract is priced correctly, we compare two key prices, that is actual future price and fair future price. Okay. Actual future prices is the real price quoted on the exchange, determined by market forces, supply and demand. Okay, it is the actual price which is actually quoted in the market on the date of expiration. Okay, the fair future price is determined based on it is actually a time value of money concept. The present value will take a will compute the future value by we have a present value, that is spot price. We will convert that present value into future price. We will get the fair future price. Okay, futures the contract. Okay, also we have so many meanings for futures. Futures price. We will enter into a future contract. Also for a future price. Okay. Now we have a spot price. We will convert that spot price into future price by adding the cost of carry model. Okay, fair future price. Take a spot price plus spot price into R into T. That will we will get the theoretical price or a fair value, which is actually a fair value, guys. Nothing but the time value of concept we will be using in the inter game will be used in this formula. The formula is very, very easy to understand. Okay, the formula. First one is F equal to, that is future price equal to spot price into 1 plus R into T. R is a risk-free rate of interest per annum. Okay, we'll take a per annum and into time to maturity. If it is given in 6 months, then we will get a 0.5 or in years. So in years, the contract is for 6 months, then 0.5. This for 12 months, 1 3 month 0.25, 1 month 0.5. So divided by 4, 0.25 divided by 12. .08. We consider in a years. Okay, multiply பண்றதுக்கு. Simple. We have 3 formulas: simple interest compounding, continuous compounding, monthly compounding. Okay, forwards and futures, spot price of the stock and index. Also, we have risk-free interest rate, that is, it will be taken as a per annum basis. The question is given in monthly or a 6 monthly, then we will have to consider based on the given data. We have to alter the formula. Okay, this we will know is not a big deal for the CA final student. You are in a CA final, so rate will be taken based on the contract period from spot market, spot rate date to current date to future date. Okay, based on the given data, we have to take risk-free rate and the time to maturity. Okay. Future price equal to spot price into 1 plus RT. That is spot price plus, can also rewrite this formula as spot price plus spot price into R into T. So you will add this value, you will get a future price. That is, this is the cost to carry. This is the spot price. In our formula, we have based on the current price and the cost of holding the asset. The spot price plus cost of holding the asset is get a value of future price. Okay. In case of continuous compounding, the same formula, but E value is given in the question. Then we have to compute the future price at a continuous compounding. If the question is mentioned in the question is telling you to compute the continuous compounding method, we have to use this E power RT. Okay. E value will be given in the question. Don't worry. You don't need not to learn how to compute E power RT. Be always given in the question. So ICAI will not test you this kind of mathematical calculation. They will give you the value in the examination. Okay. Monthly compounding. In case of monthly compounding, we have to divide this R by N. That is number of compounding period per year. That is N is 12 months means to take number of month. Okay. N into T. That is number of compounding period. Actually, N is 12. 12 into T is time to maturity. We'll get the value of, if the time to maturity is 6 months, then number of month per year. Number of month per year is 2. 2.5. We'll get a value of 6. Okay. The future price. I'll give you the examples. Our price is 100 plus 2 plus rate is percentage. Number of month 12. Okay. Our contract is for 0.5 years. Okay. Get a value of 100 into plus divided by 100. 0.01. So 0.01. The value is 100 into 1.06152. So 106.52 is the future price. Okay. Cost of carry is 6.152. We check the value 0.01. So note the pricing of the formula. Okay. I think you have understood the simple interest compounding. Okay. Also, continuous compounding is very, very easy. This value is given in the question. You have to find the spot price multiplied with this number. Okay. You will get the future price. In case of monthly compounding, you have to give a more attention to the question. Okay. Key note. Pricing of formula of the dividend. Okay. ICAI will not give simple questions. Okay. So they will give a dividend. The stock or index pays dividend. Okay. You have entered into a future contract. Also, that stock or index pays the dividend to you. Then how will you adjust the dividend amount in the spot price? So if we are paid on a face value, questions will be told you dividend is paid on future face value, or dividend will be paid on dividend yield. Okay, the percentage will be given in the question. Then how the formula is used. Also, I have given you the summary. Now we'll learn when the dividend is paid on face value. So what we have to do is deduct the present value of dividend. Okay? Deduct the present value of dividend. The future dividend is paid in future. Okay, after 3 months, the question will told you after 3 months the company is paying dividend. Then what we have to do? We have to reduce the present value amount the spot price. Okay, spot price of the stock or index. So the formula compute present value of dividend. How will you find the present value of dividend? Dividend. Okay, D or a present value factor multiply பண்ணா கூட நமக்கு கிடைக்கும். ஓகேவா? Dividend into present value factor ஓட multiply பண்ணா நமக்கு present value கிடைச்சிரும். Okay, PV factor. So to find the present value of dividend, we get a formula. Simple formula we will be using in the security valuation chapter. That is dividend into present value factor. Okay. You can use this formula also. In case E power RT is given in the question, then we have to use this formula. Simple interest compounding. Derivation of formula is very, very simple, guys. This is the time value concept only. So don't take this as a complex chapter. The finding the future value is very, very simple concept. You have to just learn that formula. It is a present value only and also future value. We will be finding the future value and also present value. We have to reduce the present value of dividend in the spot price. Then we will get a value of price. Okay. Have to deduct the dividend, present value of dividend from the spot price. So we will get the income. So we'll be eliminating that income in the, this is the inflow. Okay. We will be finding the outflow, present value, future cash flow, future price we will be finding. So future outflow, we have to reduce that inflow. Okay. So simple interest will be finding future price equal to spot price minus present value of dividend. The present value of dividend in case of simple interest compounding, D divided by 1 plus RT or D into present value factor. So in case of continuous compounding, D divided by E power RT, D divided by E power RT. Same formula, okay? What we will be doing in this formula, we will be multiplying with a spot, okay? The same is divided, dividend divided by this amount. In a layman language, we will be multiplying with this spot price. Now we will be dividing this. But in case of this, we have to consider this, okay? This time period, T will not be the same for, in case of future contract, T will be different. Also in case of dividend, T, this case also T will be different, okay? Both will not be same in the questions given in the question. The dividend will be paid in within 2 months, but the contract, future contract is for 3 months. So we have to careful in identifying T. In case of both the formula, we have to use. In case of if some question tells you dividend will be paid in 2 months, dividend be paid in 2 months, we have to consider 2 months for dividend calculation. In case of future calculation, we have to use the T. T will be 3 months. Okay, so we will be careful in determining T, that is time to maturity. In case of time to maturity, we will be using 3 months. In case of dividend will be paid within 2 months. Questions specifically say that the dividend will be paid in 2 months. We have to consider 2 months. If nothing is given in the question, we have to assume the dividend will be paid in 3 months. Okay. So monthly compounding. In case of monthly compounding, will be D divided by 1 plus R divided by N. That is 12 months or 365 days into N into T. 12 into 0.5 years or 0.25 years. That we have to multiply. Okay. Note. Give more attention while determining Adam. Same I have told you, no. Same point. That is determining number of month for future contract and a dividend. It will differ in some questions. Questions can differ. Okay. If dividend yield is given in the question, okay, face value. We are not computing dividend on a face value. The dividend yield percentage is given in the question. Then what we have to do? Deduct a D, that is yield, from risk-free interest rate per annum. Okay, free interest rate per annum. So the same formula in case of R, we have to reduce. Wherever we wrote the R, we have to reduce D. Okay? R minus D, R minus D. Also, this case also R minus D. Same formula. In case of dividend comes present value of dividend. In case of face value, we have to deduct from the price. In case of dividend yield is given in the question, then we have to reduce that dividend from a risk-free interest rate. Okay, that is rate of interest. We have to reduce that. Next, the summary of forwards and futures pricing. It's a very, very easy. Okay, whatever we have learned in these 2 pages will be summarized here. Okay, so dividends, the simple formula, simple interest, future price equal to spot price into 1 plus RT. For examination day, on the date of examination, you have to cover this only. In case of studying, you have to cover this. Okay, on the date of examination, you can cover this only. Okay, it will be time saving. I have given you all the summary formula in the every chapter. Okay, so dividend. So F equal to S into 1 plus R T. In case of continuous compounding, F equal to S into E power RT. In case of monthly compounding, the price equal to R price into 1 plus R divided by N to power NT. Okay. With the face value, in case of face value, we have to reduce from the price, present value of dividend. We have to reduce the present value of dividend from price. Okay. Now, in case of dividend yield given in the question, what we have to do? We have to reduce that D, dividend yield from risk-free interest rate. Reduce the risk from risk-free interest rate. Okay. Types of compounding method is specifically mentioned in the question. Use that method. If types of compounding is specifically given in the question, you have to use that method. In case method is not given in the question, what we have to? Otherwise, simple interest method is applied. Okay, you can use simple interest method. If E value is given in the question, then we have to use continuous compounding method. So which compounding frequency to use in the different situation is given. I have given you the table. Continuous compounding risk-free interest rate is given in the question, then we have to use continuous compounding. Daily compounding is mentioned in the question, we have to use continuous compounding. E power value is given in the question, we have to use continuous compounding. 1 month interest rate is 12%. 1 month interest rate is given in the equal to 12% means we have to use monthly compounding. This per annum that 1 month interest rate is given. So we have to compute monthly compounding. It's an indication that the compounding is happening on a monthly basis. Okay. Interest rate equal to 0.9% per month. Okay. Then also we have to compute the compounding by monthly compounding. So if you focus on this point, you will easily get the mark. In the examination, student will have a confusion in deciding which method to use. They will know the formula, but they will stuck the deciding formula and writing the formula, which method is used there. So they will confuse. So that I have put some effort for you to provide these information by analyzing all the questions in the ICAI material and other questions. Okay. You can feel that why these much of information is given in the notes only for you to get the clarity and also confident to use the formula in the examination. Interest rate is 0.4 per quarter. So quarterly compounding, that is monthly compounding. It is also called as monthly compounding. 2-month interest rate is 12.5% every 2-month compounding. That is monthly compounding. Otherwise, use simple interest compounding once. Okay. The simple question will the example. The stock is currently trading at 1,000. That is spot price. Okay. This yes. Next, interest free or 6% per annum. Okay. Next, the contract matured at 6 months. That is T is 0.5 per year. Okay. 0.5 years. Okay. The dividend of 20 is payable on the face value of the stock. 20 is payable. The dividend also 20. Okay. Straight away given 20 is payable. Okay. Calculate. Simple interest method, continuous compounding method, and monthly compounding method. Okay. How to compute simple interest method, continuous compounding method, and monthly compounding method. E value is given. So the continuous compounding method is to be used. Okay. In case of simple interest, first we have to compute present value of dividend. Okay. And the dividend once the question is asking you dividend is provided in the question, we have to first compute the present value of dividend. Present value of dividend equal to present value of dividend equal to T divided by 1 plus RT. So dividend is 20. Okay. That's clearly given in the question. 1 plus RT. Okay. 1 plus RT. R is 0.06. That is 6% given in the question. We have to convert this into 6 divided by 100. We will get a value of 0.06. Okay. In numbers. It is given in the percentage. We have to convert it in the number format. So the year is 0.5. So multiply with 0.5. We will get a value of 0.3. Plus 1. We will get a 1.03. So 20 divided by 1.03, we will get a value of 19.42. Okay, 19.42. What we have to do with the present value of dividend, we have to reduce from the spot price. The spot price is 1,000 rupees. So we will get a adjusted spot price. What is adjusted spot price? Spot price is 1,000 minus 19.42. We will get a value of 980.58. This is adjusted spot price after adjusting the present value of dividend. Okay, now we will be finding the future value. So in case of dividend is given, then we have to compute first we have to compute present value of dividend. Next we have to compute future value of the contract. Future price of the contract, that is fair value or theoretical price. Can be given in the question that compute theoretical price. You should not be in the confusion in the examination. There's nothing but the future price. Okay, the future price equal to spot price into 1 plus RT, the same formula we'll be using. Price is 980.58. This is adjusted spot price. So 1 into 0.06 multiplied with 0.5. We will get a value of 980.58. So 1.03. We will get a value of 1.03 1009 rupees is the future price. In case of continuous compounding, we have to compute present value of dividend. So there are 2 E values are given in the question. Okay. There are 2 E values. Okay, the minus symbol is given in the question, we have to multiply with the present value. We can easily multiply. This is actually a present value factor. Okay, we have to divide in case the future value factor is given. In case of future value factor is given, we have to divided by future value factor. Okay, in case the future value is given and the present value factor is given, then we have to multiply. Okay, we'll write this formula. In case the value is given as that is dividend. Future value is given, we have future value factor. Future value factor. How to divide. In case of future value is given, also present value factor is given, we have to multiply. Okay, this way we have to. Okay. In case of continuous compounding, d into e power minus rt. That is, we have this is the future value factor. Present value factor. Present value factor. In case the question is gives you the future value factor, we have to future value divided by future value factor will give you the present value. Present value of dividend is 20 into e power this amount will give you 19.41. Okay, we have to adjust the spot price. Adjusted spot price is 980.59. Okay. F equal to S into e power rt. The same formula we have to use. So we get a value of 1010.47. Okay. So monthly compounding, the 6 month monthly compounding. We can also use the monthly compounding. Question is specifically told you monthly compounding. We have to use the monthly compounding. Compute present value of dividend. T dividend divided by 1 plus r power r divided by n into t. So r is percentage divided by 12. 12 into 0.5 will get a value of 19.41. The present value of dividend is 19.41. In every cases, the present value is similar. I think interest only we got the value of 19.42. The one point is missing. Okay. Now we'll be computing future value. Future value equal to adjusted spot price into 1 plus r divided by n power. Get a value of 10.1000 rupees 10.38. After computing this, the question is asking you to identify whether market situation in the future is a contango or a backwardization. Definition: the future or a forward price is higher than the spot price. The future value, we have computed the value, that is 1010. Okay, the future price is more than the spot price. In our example, spot price is 1000 rupees. This is more. Okay, spot price is less, future price is more. Then the market situation is contango. The backwardization means the spot price is more, future price is less. Then it will be called as backwardization. Okay, this is the major difference. The question will ask you market situation, whether it is a contango or a backwardization. We have to decide by this. Okay, if spot is less than the future, then contango. It is a backwardization. Spot price is more than the future price. Forward price, future price is higher than the spot price. In this case, future price is lower than the spot price. I have given you the example. You can understand by this example, this market is in the contango market. Okay. Now we will be moving to price of one future contract. Price of one future contract. Price of one future contract. Price of a single future contract is simply the future price of underlying asset. It's actually quoted trading price of future. It is the actually quoted trading price of future. Okay, we have to compute actually quoted trading price of futures. So how to compute price of one future contract? One future contract equal to actually quoted price of future into lot size. Lot size is nothing but we have to purchase the lot actually quoted trading price of future into lot size. Lot size is the number of underlying asset shares with commodities. Okay, one lot consists of 100 shares. Okay, number of shares are a unit in a contract. One contract. Number of times the delivery in the contract are minimum trading lot. Okay, or a contract multiplier. This will be given in the question that wordings used in the question. Number of shares are a unit in one contract. or number of times delivered in the contract, minimum trading lot, contract multiplier, or trade multiplier. Quoted price. Quoted price is nothing but actually quoted in the future contract is currently trading. Okay, actually quoted currently trading future price. Okay, or the future date is the actually quoted price of the future. Will be given in the question most of the case. If it's not given in the question, then we have to assume that a future the theoretical price we will be considered as a actually quoted price. Some question the data is missing. We have to assume that the quoted price is theoretical price we have computed using that pricing formula. If actually quoted price of future is not given in the question, then assume it as a theoretical fair price. I told you now, same. It will be given in the notes. Okay. Quoted future price is 1500 per share. Lot size is 100 shares. Okay. In one lot, 100 shares are there. So price of one future contract is per share price is 1500. So lot size is 100 shares. So per share into 100 shares equal to 1,50,000 is the one contract price. Okay. Contract value. Contract value equal to price of one future contract into number of contracts. How many contracts we will be entering will be decided based on the number of contract. The price of one future contract we have already computed, that is 1,50,000 by using the formula. Price of one future contract equal to actually quoted trading price of future into lot size. Price of future of one share, okay, into multiplied with lot size. So the contract value will be determined using price of one future contract into number of contracts. Okay. Case of index, one share will not be able to buy the index. Okay, they will have a large size. Okay, and the amount is fixed. Size of one contract will be fixed to 20,000. Okay, the index Nifty 50 or a Bank Nifty have a 50 top company shares. Okay, that will be consolidated and the lot size is fixed. Okay, one contract is to buy the index Nifty index will be 50,000. Okay, but the share of Reliance will be 200 250 rupees. But we are entering into the index to buy. We have to buy minimum trading lot. Okay, minimum trading lot is fixed in the contract. So contract value price of one future contract into number of contract will be purchasing. Sometimes the question will ask you to find number of contract. Number of contract, how will you find total exposure amount? That is total amount. That is exposure, risk involved amount, risk amount divided by price of one future contract. Example, the value of portfolio held as 15 lakhs. Beta, that is risk. Okay, 1.5. Nifty future index is 20,000. Okay, lot size is 50. So lot size into Nifty future index will give you 10 lakh rupees. Okay, so the total exposure amount, that is we had to sell future to hedge it. Since the portfolio is long, okay, what do you mean by long and short? I will tell you on AF calculation. Okay, long position and short position. Okay. How to number of contract to be computed, exposure value into beta divided by price of one future contract. How will you find price of one future contract? It's the actual price into lot size. That is 10 lakhs. So 22 lakhs, 3,000 divided by 10 lakhs will give you 2.25, or normally we have to round it up to downside rounding off should be done. Okay, downside, that is in case 2.75 or 90 வந்தா கூட நம்ம வந்து கான்ட்ராக்டை வந்து 2 தான் ரெடியூஸ் பண்ணிக்கணும். ஓகே, downside rounding off should be made. Now learn formula for AF on future. AF is nothing but CA student will be learning how to compute the profit. Profit equal to sales minus cost. Okay. What do you mean by sales? Sales is cost. Okay, cost is an entry price. That is entry price is price of future contract, initially contracted price. Okay, the cost is initially contracted price. Okay, this entry price, still contract price. Sales is price at a maturity. Okay, simple terms. So for a long position, buy futures first, sell later. Okay, futures market, we will not be having any physical holding of shares. We will just enter into the contract. We will fill the contract future date. Okay, minute, quarter break. Okay, let's start. Formula for formula for AF on future contract. Okay. AF on future contract. If we are going to the future contract, we will be getting the gain or loss. AF means it's the gain or loss in the contract. How will you find the gain or loss? In case of profit or loss, we will be computing sales minus cost. Okay, the same as sales means settlement and settlement price on maturity. The price of the futures on maturity, that is settlement price. The cost. What do you mean by cost? Initially contracted price. Initially contracted price. That is entry price. We will be having settlement price and entry price. The payoff will be based on case of long position. In case of long position, we will buy futures first. We will enter into a contract to buy. Okay. Later, we will sell that yes. After settlement, we will sell that future. Okay. I see in the example, you will able to understand this concept. The long positions mean it is a buy contract. It's a buy contract. Okay. Long position. The term long is going long or a short is a term used in the market. Don't get fear of words used in the trading platform. Okay, it is just a word. It just the long means buy. Okay, short means sell. Okay, it's a word. Different word used for long and short is sell and buy. Okay, different words are used in the market. So just given in the question also. So just remember, long is a buy first and sell later. Okay, if you are in a long position, you have to buy the future contract. Okay, you have to enter in the future. So later on, after settlement, we have to sell the futures in the spot market. Okay, now we will be buy contract in the future market. On the date of maturity, we have to sell that in that spot market. Okay, AF. AF equal to settlement price minus entry price. So settlement price is maturity price minus entry price. In case of you are going for a long position, the sales is settlement price. Entry price is your cost. Okay, settlement price minus entry price into lot size into number of contract will give you the gain or loss. Now I will discuss the example. Also, the PF also can be calculated using contract value into percentage rise or fall in future price on maturity. Sometimes the question will give you the percentage of rise or fall in future price on maturity will be given in the question. Then we have to use the contract value into get the price difference will be in free price, large size, number of contract will give you the contract value. Same also used in this. Okay, contract value is nothing but free price into large size into number of contract. So percentage is given in the question. Then we have to use contract value into percentage of fall or price in the future in the market on the date of maturity. Okay. For example, entry price is 1500, settlement price is 1600. On the contract date, that is 1st April. On 1st April, I have entered into a contract for 1500. On the maturity, that is future date, price becomes 1600. I have entered into a large size of 100 shares and the contract for 2 contracts. So total 200 shares. Okay. So payoff will be settlement price is high. Okay. Settlement price is 1600 minus 1500. I will get a value of 100. So 100 into into 200, I will get a gain of 20,000. In case the entry price is 1,600 and the settlement price is 1,500, I will get a loss. Okay, loss of 20,000. I hope I understood the concept. Long position. Case of long position, gain or loss will be computed based on settlement price minus entry price. If settlement price is more than the entry price, you will get a gain. If settlement price is less than the entry price, you will get a loss. Okay, the easy concept, guys. Okay, settlement price is price of the contract on maturity. Entry price is initially contracted price. Simple English. Case of short position. First, we will enter into a sell future. Sell future. Will you sell சார் எங்கிட்ட காசு நான் பை வேணா பண்ணலாம் ஆனா ஃபியூச்சர்ஸ்ல போயிட்டு நான் எப்படி செல் பண்ண முடியும் அப்படின்னு கேக்குறீங்க. ஒரு சிலருக்கு வந்து புரியாது. இந்த கான்செப்ட் புரிஞ்சுக்கிட்டா மட்டும் போதும். ஓகேவா? ஃபியூச்சர் மார்க்கெட்ல செல்லும் பண்ணலாம் பையும் பண்ணலாம். நான் வந்து செல் பண்றேன்னா எங்கேயோ இருக்கிறவங்க வந்து பை பண்ணுவாங்க. ஸோ பிஎஸ்சி என்எஸ்சி வில் intermediary for us. Okay, one person can sell, another person can buy. Already I have told you, derivative contract is a agreement between two parties to buy and sell. One party will buy, one party will sell. Okay, if I have entered into a future contract to sell, what will happen? I have to learn. Okay, I have told you in case of long position. Case of short position, that is sell contract. First we have to enter into a future, sell future. Sell future and buy later. Okay, I will enter into a sell future contract. Then I will buy the shares of that company in our index for the maturity. The payoff for imputed entry price minus settlement price. What he will think in case of sell future. In case of our example, Mr. B has expectation that price will decrease, so that he will be entering into the sell contract. Okay. Case of he is entering a sell contract, he has the expectation that price will decrease. So entry price is this, settlement price is reduced. He has expectation that price will decrease. Settlement price will be lower amount. If settlement price is lower than the entry price, he will get a gain. He has expectation that the price will decrease. So based on the entry price, he will expect that the entry price is sales value. Okay, for him, entry price is the sales price. Settlement price is the cost. So entry price minus settlement price into lot size into number of contracts will give you the payoff. That is gain or loss. In case of settlement price is more than the entry price, he will get a loss. Okay? Settlement price, the entry price he has to pay to the person. Okay, the payoff, the different formula can be used. In case of percentage is given in the question, then we have to compute contract value into percentage of raise or fall in the future price on the maturity. Okay. Example, entry price is 1,500. He has an expectation that price will decrease. So actually settlement date, the price is decreased to 1,400. So he will get a profit. 1,500 minus 1,400, 100 into 300. He will get a profit of 30,000. Okay. In two examples, their expectation is met. Okay. He has an expectation that the price will increase. Actually, the settlement price, maturity price is increased. In this case also, he has an expectation that price will decrease. In this case also, price also decrease. So they will get a profit in both the scenario. Case expectation is not met in the on the date of maturity, they will get a loss. Okay. The price is 1,600. Instead of 1,600, it will be 1,400. He will get a loss of 20,000. In this case, if I am going long position, so another person also go for a short position in the future market. Okay. Then if I get a profit of 20,000, the other person, Mr. A, got the profit of 20,000, then Mr. B will get a loss of 20,000. In this case, short position, Mr. B got a profit of 30,000. Mr. A will get a loss of 20,000. Summary of gain or loss. Okay. Summary table computation. In case of a long position, buy first, sell later. Okay. Formula: settlement price minus entry price into lot size into number of contract. If profit condition, settlement price is more than the entry price, then you will get a profit. Case settlement price is less than the entry price, then loss. Case of short position, first we have to sell the future and buy the shares at a later date. KF equal to entry price minus settlement price into lot size into number of contract. Settlement price is less than the entry price, then position will give you profit. In case of short position, loss will happen. In case of settlement price is more than the entry price. It's expectation. Again, I will explain. In case of long position, we have expectation that price will increase. So we will enter into a buy future contract. Buy future contract. Today, the price entry price is 1,500. I have expectation that price will increase. So I have entered into a future contract. The price is actually increased to 1,600. So I will get a profit of 100 into 100 shares. So I will get a profit of 20,000. In case of a long short position, I have expectation that price will decrease. So entry price is more than the settlement price. I have expectation that entry price is more than the settlement price. So entry price is 1,500. The settlement price is 1,400. So 1,500 minus 1,400 will give you 100. 100 into 300, then the profit of 30,000 will arise. In this case, person having the short position in this case will get a loss of 20,000. In case the person having a long position will get a 30,000 loss. Okay. Gain equal to another person's loss in the future market. Also, if percentage increase or decrease in price is given in the question, future price on maturity can be calculated using this formula. The future price on maturity, future price we have to compute. How will you compute the future price? Future price equal to entry price into 1 plus percentage increase or percentage decrease. Okay. Right. You have understood how the payoff in future contract works. Okay. Types of margins. I have told you now the future contract is run on a maintenance margin requirement. Okay. I have told you difference between margin requirement. In case of forwards, margin requirement is not required. In case of future contract, margin is required. There are different types of margin. Different types of margin in future contract. First one is initial margin. The initial margin is the minimum amount required to enter into the future position. To sell a long position or a short position to act as a security deposit. Initial margin is a security deposit to cover the potential losses. First, I have to enter into a future or a future contract. So long position or a short position I will take. For that, I have to make a deposit of initial deposit, that is security deposit. So initial margin I have to deposit. So initial margin will be computed. It will not be given in the question. Future price on future price into lot size into initial margin percentage given in the question, or initial margin equal to contract value. That is future price into lot size will give you the contract price. Contract value into initial margin percentage, or if contract value or anything is not given in the question, then we have to use initial margin equal to mean, that is mean average historical price movement, that is daily absolute change amount contract value, that is mean value into 3 standard deviation of price movement. This is also price movement, that is average price movement, also standard deviation of price movement. Okay, mean plus 3 into standard deviation of price movement. We'll multiply this, we'll get a value of initial margin. Okay. Mark to market margin. What do you mean by mark to market margin? Daily profit or loss settlement based on the price movement. Daily profit or loss. I have told you now in future contract there is a daily price movement in the contract. So it will be settled on a daily mark to market margin. Okay. Daily profit or loss settlement based on the price movement. If the market price moves against the trader, additional margin, that is margin call money has to be required. Okay. Mark to market margin equal to closing price of today minus closing price of previous day settlement price. Okay, this will be reduced into lot size into number of contract. Closing price of today. The closing price of today is given in the question. Also, closing price of previous day also given in the question. The difference between today and previous day. Today price of today and price of previous day, yesterday. Today minus yesterday. We reduced and the lot size into number of contract. Okay, multiplied with lot size and the number of contract, we get a margin. Okay, that is today. Yes, today is 100. Today is 90 rupees means get into. I have entered into a lot size of 200, 100, and also number of contract is 10. Then what is the mark to market margin? What is the margin? 10 into 100 to 10. Then the margin is 10,000. Okay, one day margin is 10,000. Today's margin is 10,000. The stock market price is most everyday basis, day by day basis. So settlement is based on the day by day basis. So in case the maintenance margin, the net gain is net gain 10,000. The initial margin is for 15,000. Okay, gain also 10,000. So 15,000 plus 1,000 will be 25,000. 25,000 is my margin account balance. In case my initial margin is 15,000, I will get a loss of 20,000. Then my margin account is negative, minus 5,000. So I have to bring 50,000 into the margin account, maintain my initial margin. That is maintenance margin. What do you mean by maintenance margin? We have to minimum margin that must be maintained before a call. Okay. Case initial margin is below the mark to market, we have to require call money. Okay. I have example for you. You will able to understand this. How the maintenance margin, initial margin, and the mark to market margin works. Maintenance margin, minimum margin that must be maintained before call. Good. Okay. Yes, I'll give you the example. If initial margin 15,000, so maintenance margin is 10,000. If I get a loss, okay, loss of 9,000. So my loss is 9,000. My initial margin is 15,000. Okay, I have a maintenance margin 10,000. So my loss is up to maintenance margin. So I need not to bring any amount to the as a call money. Case my loss is 11,000. I need to bring the amount up to 15,000. That is, I have to bring the amount up to that is. I will explain you this example only. Minimum margin that must be maintained before the call. The account balance falls below the maintenance margin. That is account balance. If I get a loss of, I have wrote the example now. That is, I have below the maintenance margin. If my loss is 11,000, my maintenance margin is 10,000, and I will get a loss of 1,000 rupees. Okay, that is below the maintenance margin is 1,000. I have to bring the amount deposit more than this amount. I have to bring the deposit up to the initial margin, up to the initial margin. Call money, margin call I have to bring. Maintenance margin. How will you find the maintenance margin? Maintenance margin equal to initial margin. So maintenance margin percentage on initial margin. Be given on a maintenance margin, or it will be separately given in the question as a percentage on contract value. Contract value is used if the percentage on contract value is given. If initial margin is used in case of percentage on initial margin is given in the question. Note, use formula based on the information given in the question. Okay. Margin call. How to compute call money? That is margin call amount. Margin call equal to initial margin minus margin balance. Okay. Margin balance, that is margin balance account as closing balance is maintained. Balance after adjustment of mark to market. Margin account formatted. நம்ம போடணும்னு சொல்லிட்டு ஒரு எக்ஸாம்பிள் கொடுத்துருக்கேன். If the trader enters into a long, okay, long position and short position, I have told you now, settlement price, the same will be used in this formula to compute mark to market margin. That is nothing but payoff on a daily basis. Okay. This question, the trader goes for a long futures contract with the following details. The initial margin required is directly given in the question, 15,000. Maintenance margin is 11,250. That is 75% of initial margin. Lot size is 100 shares. Contract is one contract. So 100 shares is the contract size is one contract. Also 100 shares. Entry price, that is previous day price, 1500. Daily settlement on a day 1, 1500, day 2, 1480, 1450, 1470. Fifth day, 1485. So we will open the margin format account, calculate mark to market margin, margin balance, call money if required, and the closing balance in the margin account for each day, and the compute PS. Okay. Opening balance. Opening balance of margin account. What is my initial margin? 15,000. So initial margin I will be my security deposit, that is to the stock exchange. That is 15,000. Okay. Out of 15,000 on day 1, mark to market margin, that is 1,500 minus 1,500, 1,500 minus 1,500 be 0 into 100 into 1. So my mark to market margin on the date of first day is 0. My balance after adjusting mark to market margin is 15,000. Call money is not required. Actually, I am maintaining maintenance margin, and initial margin is more than initial amount only. So I need not bring any call money. Closing balance also 15,000. On day 2, opening balance is 15,000. Market margin have to compute. Price today. Price today is 1,480 minus 1,500. Right? I will get a loss of 20. Okay? 20 into 100. So my mark to market margin loss of 2,000. So after adjusting the mark to market loss, that is 2,000, my balance is 13,000. There is no requirement to bring call money because it's in the balance is in the maintenance margin. 7,050, 13,000. Day 3, my opening balance is 13,000. On the date, the price today is 1,450. 1,450 minus 1,004, 1,480. So 30,000 is 30 rupees loss on per day into 100. My total loss is 3,000. So 13,000 minus 3,000 will be 10,000. So I have to bring, this is lower than my maintenance margin. I have to maintain 11,250. My balance in the margin account is 10,000 now. What I have to do? I have to bring the margin up to my initial amount. So I have to bring 5,000 in my account. 5,000 should be deposited in the margin statement. So I will bring the initial margin amount of 15,000. In case the margin balance is goes below the initial margin amount, I have to bring the amount up to the initial margin amount. Okay. I will bring the 15,000 now. So 15,000 is my amount. Now I have made some mistakes in this. 15,000 is my opening balance on this day. Okay. After 15,000, so on day 4, today is 1,470 minus yesterday is 1,450. I'll get a 20 rupees profit into 100. So 2,000 gain. 1,000 gain. 1,000 gain plus 1,500. 15,000 plus 2,000 will give you 17,000. Okay. I have made a mistake in this. 15,000 plus 2,000 will give you 17,000. So there is no need of call money. 17,000 is my answer. Also, on the date of opening balance, 17,000 is my balance. Also, I got a value of on 15th day, 1,485 is my today's value minus yesterday value is 1,470 is my 15. So into 200 will be 1,500 is my gain. 1,500 is my gain. So 1,500 plus 17,000, total margin upon balance is 18,500. Okay. Net payoff amount. What will be the net payoff? The question will ask you, how will you compute the net payoff amount? Net payoff amount equal to closing balance of margin account at the end minus initial margin amount plus call money. Initial margin amount plus call money. Closing balance is 18,500. 18,500. 18,500 minus 20,000. 1,500 loss. Okay. Also 18,500. Okay. So this will revise quickly. For quick revision, we will wind up this part 1 video of derivatives. We'll learn hedging through free futures in next video. Meaning of derivative. Derivative is a contract between two parties. There is an agreement between two parties to buy. One party will sell, one party will buy the contract of underlying asset, okay, on a fixed price for a future date. Okay, will be settled on a cash settlement. In most of the questions, the cash settlement is made. Also, there is the concept of physical settlement. Types of derivative contracts: forwards, options, futures, and swaps. Participants: hedger, speculator, and arbitrager. Also, we have a forward contract and future contract. In case of forward contract, it is a customized contract. In case of future contract, it is a standardized contract. Forward contract is happening on a over-the-counter basis, and also in case of future contract, this is traded on a NSE and a BSE exchanges. Also, pricing of forward future contract is also cost of carry. That is spot price plus cost of carrying the underlying asset. So, compute it is used to compute three methods in the computing future value, or a fair price, or a theoretical price. It will be computed based on simple interest compounding, continuous compounding, monthly compounding. It is nothing but it is a time value adjustment will be made in the spot price to bring the future price. Okay. In case of face value, in case of dividend is given in the question, we have to compute the present value of the dividend, and we have to reduce the amount spot price minus present value of dividend. We will get a adjusted spot price. Okay. Using this adjusted spot price, we will compute the future price. In case dividend yield is given in the question, then we have to reduce from the risk-free rate. From risk-free rate, interest rate is also given, and so dividend yield rate is given. Then we have to reduce from the risk-free rate. Okay, the summarized table is also given. So we have the example. Also, contango and the backwardization. It will be the forward prices, forward or future price is more than the spot price. Then it is in market is in the contango situation. In case future is lower than the spot price, then the market is in the backward situation. Okay. Price of one future contract is computed. Price of one future contract equal to actually quoted price into lot size. It will be given in the question. Contract value or a total exposure value. Contract value is equal to price of one future contract into number of contract. Position to be taken. Okay. Number of position to be taken will be my contract value. Price of one future contract. Or it can be computed actual price into price of into lot size into number of contract will give you the contract value. Okay. Formula for payoff. In case of long position, settlement price minus entry price into lot size into number of contract. Also, payoff can be calculated using contract value into percentage of rise or fall in the future price on maturity. Okay. In case of short position, entry price minus settlement price. Entry price minus settlement price into lot size into number of contract. In case of contract value into percentage of rise or fall in the price on the maturity be taken. Okay. Margin, initial margin, mark to market margin, and maintenance margin, and the margin call money required. We bring the amount to the equal to initial margin amount. That hedging using futures we'll learn in next lecture.